Good afternoon, everybody, and welcome again to another edition of Between the Lines Live. My name is Vanessa Rader. I'm the Head of Research at Ray White, and today I'm joined with a great bunch of people here up in Brisbane. I've come up to visit Brisbane. You know, the weather's been a bit kind of difficult up here, but it's great to be up here and see you guys because we're talking retail today. So we've got here Michael Feltoe and also Lachlan O'Keefe here from RWC Retail. And they're the joint managing directors, so really intelligent boys here, and we're going to talk all things retail. So super exciting. Great to be here. Oh no, Michael, full of great knowledge. Because if anyone's read any of the things that I've been writing in recent times, my tip has really been retail being the asset class of choice, particularly for 2025. So we saw at the end of 2024 a bit of a surge in investment activity. We saw a few of the large institutions get out of the market. And some more private investors fueling a lot of that kind of investment. And we do think that retail is going to be one of the kind of more premier investment options of 2025. The yield play is looking good. We're not building a lot, but we'll unpack all of that now. So let's start from the top. So let's start with retail centres. The retail centres come in many shapes and sizes forms. But let's talk about kind of like your neighbourhood or convenience type centres, like a supermarket, specialties. That's an area that you guys work a lot in. And certainly an area that has a lot of demand. Is that what you're seeing?
Yeah, definitely. Obviously, there's different sizes with supermarkets and the amount of specialties bolted onto it. But certainly since COVID, there's been a lot of demand and I think a lot of recognition of just how important of a role they play in our society. I think there was a bit of question mark over the move to online sales and how much that would impact things, and certainly, you know, in the bigger, more regional centres like your Westfields, they're looking at ways to change and bring people in and the entertainment side of it, but certainly for those smaller neighbourhood centres and even smaller again, the little retail strips that just support the suburbs, they've proven that they can withstand difficult times and that people enjoy getting out of the house and going to them and supporting their local business. So. Yeah,
it's interesting your point that you touch on there with the online retail trade. So we did think there was going to be this massive push to everyone's going to be doing their online shopping. And yes, during COVID, we did see a spike because there was no other way of getting groceries and things like that. But we have started to see that moderate in terms of the total volume of retail transactions. It's grown a little bit, but it certainly has slowed down in terms of its growth. And you would be fair to say that it's very not asset specific, but kind of use specific. So your clothing and soft goods, yes, people are buying that online. But when it comes to services, you can't go get your hair cut online, can you? And you can't get your nails done online. And if you want to do your grocery shopping, yes, there is people that are doing online shopping or they're doing click and collect, but it doesn't reduce the need for that local supermarket. So perhaps it's more the retail mix in these little centres that have changed a little bit. What do you think, Michael? Like it's more of that kind of service driven?
More professional, more service offerings, food and beverage, and ultimately convenience has been everything. So we've all been working from home more broadly, and it's definitely, we've all seen an uptick in the amount we're going to our local convenience retail centres.
And the idea of being able to drive in particular, we spoke about this earlier, that we do like that really local centre that we can drive in really easily, go out, do your kind of grocery shopping, maybe pick up a coffee, get something to eat, get your nails done, and then get back in the car pretty easily and leave. And so that's probably the sweet spot, would you say?
It makes and breaks it.
But is that the sweet spot for the investors that we've got in the market now? Like private investors are super strong in this price point. What's this price point look like?
Yeah, I mean, private investors themselves, they've been the most active in the market all the way up to your sub-regional $80 million shopping centres. And I think that's for a couple of different reasons. One is probably the institutions and the funds have found it difficult since the rate rises have come in to make sure that they're still offering a decent enough return for their investors. And so it's a lot harder for them to be competitive with some of those privates that don't have to appeal to a larger bunch of investors. But certainly on the smaller end of the market, you know, your sub 25 mil, which is probably what Michael and I do most of our work in, private investors, they come in all different shapes and sizes from all different locations.
Everyone wants something different in that space. Like
they all come from different backgrounds too. Like they've sold a business, or somehow they've come into this sort of wealth, either through different family members or what have you, and they are just looking at ways to create wealth for themselves. And I think the residential market has been good, but I think a lot of people are looking at other ways now. And, Michael and I have certainly noticed since COVID as well, there seems to be a lot more education out there around commercial property. Just more stuff online, more buyers agents, more people pushing commercial property and the benefits of it. So there's a lot more first-time investors out there as well, which is kind of in that sub 25 mil price point. And so we're seeing a lot of people come and look for those opportunities.
So with this kind of high-level inquiry, I'm assuming that creates a little bit of tension in terms of some of your results and things that are going on.
Yeah, look, there's not to try to beat the drum, but there's been so many private investors that have inquired on some of the retail centres that we've sold. Like there was one in the Hungry Jack's anchored retail centre in Coopers Plains, which had 722 inquiries, which, as far as we're aware, that's the most any campaign's ever had in Australian history for a property transaction.
And just trying to service that amount of people is obviously, it's a lot. Like, trying to make a phone call and,
There's 17 Matts.
Yeah,
it's hard to keep track of which Matt if they don't tell you their last name.
But I think
but it's a good problem to have.
It doesn't, the 722 people doesn't convert into that many bidders or even close. But, there is just a lot of people doing research out there and just trying to educate themselves on the commercial market, seeing what something goes for, just going through the process and trying to understand it.
And that's been easier as time's gone on in terms of getting access to information online. So I think most people have an understanding, whether they realise it or not, of what retail property is, because you experience it yourself every week at least. Whereas a lot of people, especially private investors that maybe don't have any experience yet in purchasing commercial property, plenty of them don't know industrial parks as well, or office towers as well as.
But they know their local shop.
Yeah, or local fast food or childcare for that matter, or GP.
That's a super interesting one. I think that that volume of activity in terms of the access to information, like we've seen ourselves in the marketplace, so many more kind of buyers agents have kind of emerged over the last probably 2 years, to be fair. And since COVID, we have seen this huge push by private investors. They've really propped up the entire commercial market, being industrial, retail, office, childcare, medical, all those sort of things. These cash-up buyers looking to diversify away from residential, which perhaps they traditionally invested in. But that's certainly a trend that keeps on going, and we really do continue to think that retail and all asset classes, commercial asset classes, will still be a lot of private investor activity this year. And in terms of you do work all over, but Queensland predominantly. Are you seeing buyers come from other states? Because that's something we've seen across the broader market.
I think 2 years ago, 3 years ago even, it was very clear that most of the purchases that we were selling to, especially sub 20 mil, for retail investments or medical investments for that matter, were Sydney-based or within New South Wales and Melbourne and Victoria. Whereas recently, it's probably ticked up to 50-50 if you had to say who's buying
from Brisbane and
Southeast Queensland.
Well, it's those people from Sydney and Melbourne that moved to Brisbane, so now they're
potentially.
There is a fair bit of that.
Well, it's following the population. Like we've seen that WA and Queensland have been probably the recipients. Well, they've been the recipients of the population, but they've also been a greater recipients in terms of transactional activity as well. So it makes sense that following the people. And on retail as well, I do want to touch on yields, because our audience probably want to know a bit of the nitty gritty of what's going on. But obviously a lot of things can affect the value, not only just occupancy, but the WALE and the quality of the asset and the quality of the tenants and things sort of things. Location. Growth corridors, access and all those sort of things. Lots of things. So your yield range is probably going to be quite large. But what do you look for these sort of assets that you're talking about, that sub $25 million space, anchored with a supermarket with specialties?
It really depends. Obviously, like retail's so broad, and I mean, we could probably get into some of the other topics like fast food and childcare and whatnot. But for strip centres specifically, we've seen, especially around the sub 10 mil market, so without like a supermarket anchor, just kind of your strip retail, those centres, we've seen them transact, or they used to transact around the 6% mark, and now they're trending down into the 5% and low 5%. I think, they all offer different things, as you said, and it comes down to the tenancy mix, how long the tenants have been there, what rent they're paying, are they at market, are they below, is there more to get out of it, how well it's been maintained, and if you've got to spend money on it, and all those sorts of things all determine that end yield. But yeah, I think we're just seeing a lot of attraction on that type of investment because of all those different levers and ways you can extract money out of a centre like that with improvements and pumping rents up. And they also seem to be in a good price point, like sub 5, a lot of them, even with 5, 6, 7 tenants. So,
and in that space, we're seeing almost on, as a bare minimum, about 350 inquiries for any sub $5 million retail centre, especially in southeast Queensland, which is, as far as we're aware, unprecedented.
And I'm thinking a lot of these are probably cash buyers too.
Plenty are.
Amazing.
Majority aren't, but there's definitely a decent amount. There's more and more as the price point goes lower for obvious reasons. But yeah, there definitely are, especially if it's sub 5% or sub 6%.
And so how about those kind of slightly larger, maybe like a neighbourhood centre that has that anchor supermarket with the specialties?
Yeah, they seem to be hovering around the 6% mark still, and that's obviously probably because they're obviously a larger price point. But I think those rarely come up for sale.
Tightly held markets.
They're very tightly held.
Especially in the last 2 years.
So it's harder to see those trends because they also normally take a long time for them to come through into the sales results. So, but yeah, we're seeing those sitting at around the 6% mark, give or take.
Some of the better ones down as low as mid 5%. But
that's not surprising.
More towards 6.
And some in the mid 6s as well. Even in Metro Brisbane, I've seen them. But once again, how well performing is the supermarket and all the rest of it? That's really what comes down to.
And how long the lease is. And what that lease structure is to the anchor.
And also that a lot of these buyers are probably looking at a longer term exit strategy as well. And is there opportunity on that side? Retail, we're talking about these retail centres usually sit on rather large parcels of land. Is there future upside there? Probably a bus stop out the front or, access to transport. That's all something that if those long term players probably keep in the back of their mind too.
Certainly. Those smaller centres that have the opportunity to go 2 or 3 stories, that's always preferred for many reasons. Obviously, people are just thinking the generations ahead, but
especially in a blue chip suburb.
I think it's very easy to look at the houses in the suburb, which, the housing market, especially in Brisbane, it's been undefeated. Melbourne and Sydney, it's been a little bit...
Sydney, let's just say Sydney.
Let's just say Sydney.
With it's 1 month of decline as well. Before bouncing back.
But it's all starting to come back now again, and Brisbane just hasn't really stopped. So I think there is a lot of investors that are doing that transition from residential to commercial, looking at the value that you're getting for that residential house and the commercial property and what the cash flow and potential future upside.
Especially if there's similar land sizes. Building size is usually different. It's usually higher in some of these retail centres, but you see 3.5 mil buys you in a house on a net return.
Yes.
Versus some of these retail centres. And whilst the yields are tight on some of these retail centres that are being sold, it's night and day.
Yeah.
And
it is fascinating. That's certainly been something that's come through in the last few years, I'd say, since the housing market's just gone crazy. Like before 2020, I would say, sure, if it was like a blue chip suburb, you might talk about the prestigious nature of it being in that suburb, but anywhere else, talking about the house prices in that suburb was just not even a second thought. You might talk about the demographics of that area, but certainly house prices weren't really a thing. Whereas now, when you sell a strip centre, it's definitely like looking at what the housing market's doing in that area and what house prices are.
And you mentioned that kind of strip retailing. I suppose that one of the things to consider, particularly when you're talking about Queensland, is because you've had this huge amount of population growth, but there hasn't been growth in retail, like new buildings, retail buildings. Like, the floor space hasn't really changed an awful lot. So your
it's not expected to
area
either.
per capita or per household is stayed pretty static. Or it's gone the other way, to be honest.
Yeah.
So occupancy improving.
Definitely, yeah. Michael and I don't do too much leasing. Obviously, we're much more on the transaction side. But like we've seen centres being leased up much more regularly,
especially with long-term vacancies. We've seen there's been some clients of ours that own centres all throughout Queensland, and they've had some tenancies vacant for a very long time, and those have been leased recently. So there's been a number of centres that we've sold and we've got coming up that have had one or two small specialty tenancies vacant. Some for long, some for not long, and most of those have been leased. So from our anecdotal experience, it feels like that has been improving.
I was just going to say the other thing to note on the smaller strip suburban centres as well is the lack of supply really comes from obviously your zoning and the council restrictions, but equally you're seeing a childcare, and we'll touch on these topics in a moment, but childcare, fast food, and these other blue chip trophy investments. A lot of those are coming out on corner sites, service stations as well, and they can get approval and get those up, but those are very tenant driven, and so like McDonald's or 7-Eleven or whoever want to be there, and that's what's driving the developer to go and get the development application, get that through, get that there. You don't have that tenant driven priority from those developers for the strip mall,
I understand.
because it's a local doctor, local hairdresser, local dentist, whatever, and they only go in there or they only inquire once you've built it.
Yeah, that's right.
So it's...
So we're not building any more of newer...
There's not much
less.
developer-driven strip centres.
Yes.
Not many people want to spec it if you're the retail developer.
Yeah, for sure. Well, let's talk about fast food, because that's something that you guys do a lot of work in.
Yeah.
And we know people are still spending money on fast food, so that's why they're growing, and I'm sure that your clients are looking for more and more sites, be it the occupier as well as the buyer.
Yep.
And you've gotten some really competitive yields. Obviously, multinational tenant, a lot of the cases, long-term lease, fixed increases. They look after the property.
Yeah.
Seems like a pretty sweet option. So what's been going on in that space?
Oh, yeah, just can't service the demand from the buyer side of things. There's always historically been a very small amount of fast food investments supplied to the market for sale. As we touched on, there's less developers building them, so most people anticipate that to slow down a little bit. Most people that have bought them or own them hold on to them for a long time, much longer than buyers or agents like. But we anticipate that that's only going to continue in demand. And from the tenant side of things, there are multiple multinationals, especially from the US, that have made it very clear they want to expand.
Yeah.
And they've got aggressive growth targets, but most of them aren't on track. And I don't think anyone expects them to actually be on track.
Yeah.
Unless something fundamentally changes, or they start going down Coles and Woolworths' path of building their own, which most of them don't.
Yeah.
Yeah,
Or at least nowhere near enough.
they all see the Australian market as quite positive from a fast food and drive-through perspective. And I think from the buyer's side, the reason that they all want one so bad is because most of the models currently in the market, when you look at McDonald's, Hungry Jack's, or Red Rooster, they've been in the Australian market for a really long time. They've got quite a big operation behind them, so you can feel comfortable they're going to pay their rent. And equally, they just kind of self-manage themselves. You don't really have to worry about them. They look after it. You got to look out for the lease clauses and make sure that it is being pretty much self-managed. But it's just this annuity style income where they buy it, they park their cash because they've got 3, 4, 5 million, and they don't know what to do with it, and they just enjoy getting that cash flow and
so
not
you can
having
see
to worry
why
about it.
it's an attractive investment,
And it
for
increases.
people. Yeah, it's just it's a cash flow investment.
It's
and
probably the easiest to understand as well.
Yeah,
Most
it's
people
the
have
ultimate.
eaten fast food. Most people can see if it's busy
It's a
or
household
not.
name.
Like you can literally stand out the front and see how it's performing.
And so what sort of Do you want to divulge some yields you're getting for those? Because there's been some pretty tight results.
The best one is Red Rooster Nunda that we're proud of 3.81%.
Yeah.
Which that was quite good.
Yeah, it's pretty incredible. I mean,
but they're long-term holds. That's why it is so.
They're
they're
often
looking
cash purchases.
Yeah,
as well.
and they're just looking for that cash flow, like you said.
Yeah. I think it just they got down to low 4%. Some got into the 3%, and certainly when you start looking down south into New South Wales and Victoria, they've gotten down into the 3% as well. But we're seeing consistent yields at the moment around mid to low 4s, and that's for regional places too, like in absolute middle of nowhere in Queensland.
Well, there's a road that goes through there.
There's a road. There's people that buy, but in terms of it's not a metro location. They're really just buying that lease.
Yes.
And some of them perform the best in some of those regional locations as well.
Because of the road.
Because of the road. Yes, that's it.
So, that whole idea of those international brands coming to Australia, that's not something new. That's been happening for quite some time. We've seen some come and some go, though. I haven't really made it in Australia.
Yeah.
I know this has nothing to do with what we were talking about, but has anyone been to Wendy's yet? Isn't there a Wendy's down
There's
here?
a Wendy's on the
In
Gold Coast. Yeah, no, I haven't been.
Okay.
I've seen photos.
Okay.
But no, I haven't been.
Yeah, so
myself.
they chose Gold Coast as their place to be, which is probably a
Surfers
smart
Paradise.
one.
Yeah.
In Sydney, they usually go out to Penrith, the big kind of land size and demographic there that probably likes like Carl's Jr. and those sort of things. That's where the first Krispy Kreme was.
I think they're only doing a chicken burger, they were saying, just to keep the menu simple to start and then expanding it.
Anyway, off topic.
Yeah.
But I did see that. That's kind of interesting. So, but back to the housing piece. With the strong growth in the housing market also probably aligns itself to the large format retail, or back in my day we used to call it bulky goods.
Yep. Yes.
So that's been an area that's also really grown in attractiveness.
That's definitely. And the price point starts to get up there usually on them, unless they're standalone. You might be able to pick one up, between 3 or 8 mil or something. But most of them come in that sort of larger format, as goes the name. But they're normally 10 plus usually, and go, obviously can go quite large. But those have been highly sought after from the funds and institutions. We've seen a lot of demand from a lot of funds and institutions on the LFR space, and that purely comes down to the fundamentals that they're looking at there is they're pretty much always a national tenant that are in there, and they're a really large land holding to begin with, and they're paying low rents. So the yield, if it's a comparative yield to, say, a neighbourhood shopping centre or something else, and you're paying 6%, you're getting a much larger land holding, hopefully in a metro location.
Yes.
And your
rents...
rents...
more building as well for that.
Your rents are much more sustainable and hopefully have a lot more room for growth as well. So, that's where they see a lot of value and something that they can, hopefully
and the yields are usually a little bit higher for those assets?
Yeah, I mean, they certainly, they want higher yields for them on the purchasing side.
There haven't been many that have transacted.
No,
full
there
stop.
hasn't been very many.
It's really hard. Because of that demand, we've certainly done the rounds and tried to see, if anyone's interested to sell, but they're just so tightly held. And I think that's one of the hardest parts about them is, the people that own them don't really want to sell because of all those fundamentals.
And they are tied somewhat to the resi market, and the resi market's been doing well, and so the occupancy has been well. It's all tied in. You've got, your hardware if you're doing any refurbishments, or you're moving, and your white goods and furniture, those sort of things. Yeah, so those assets are doing quite well. I do think, we have seen a lot of institutions really looking at those. I think there was late last year and maybe early this year a portfolio maybe out of WA that has transacted, but in terms of volume number, it's still pretty low, and yields are still they seem pretty low for what they are.
Yeah, and I
suppose
think
it's also aligned to kind of industrial, and as we know, industrial has been like the
industrial's gone great. Yeah,
so it's that kind
it's
of
the industrial
sometimes
of retail.
It's the industrial of retail.
Yeah,
that's right.
I think the other thing I was going to touch on too, circling back to the services offering and why people like suburban retail centres, it's the same thing again in the LFR where you can't just buy a bed online. You've got to lie on the mattress.
Yeah.
You can't.
And
just...
that's a big space. If you have to have more than one mattress,
Oh yeah,
you need a lot of
Same
area.
with the couch and all the other stuff that's on offer there. So it's definitely got a future.
Hence the bulky goods.
Yes.
That used to be called.
And
yes,
looking on the single tenanted LFR front, large format retail, Bunnings, Officeworks, they're some of the most highly coveted investments you can get, which as much as there's syndicates and funds that want to buy them, they have not been able to compete with private investors for the most part. And we've seen yields as low as in the 5% across the board, sometimes in the 4% for those assets.
Yeah, it's quite incredible.
And those are high price points as well for those.
Yeah,
So we're not talking small property.
Once again, those yields are really just generated from competition and the lack of Bunnings opportunities or Officeworks opportunities. Like when one comes to the market, it really is, it's quite crazy, the amount of people that want one of those in their portfolio.
Of course.
And there's just not many on offer.
I think a lot of people get caught up in there's interstate migration, retail trade is up in a specific category, but at the end of the day, as Lockie's saying, yields have been so tight because supply and demand. There's so many people and there's not much supply.
Yeah, that's right.
So we'd love to say it's us, the agents, or there's all these other metrics, but there's just not much for sale.
Yeah, well, it's a combination of not only tightly held, so not much for sale, and so we're not building anything else. We've got constrained land.
Yep.
Like even if you wanted to build a large format retail, you need to find services own land available to build it, which just doesn't exist as well. So
not in many metropolitan locations.
No. So therefore, that's just another constraint on it, which is then you have the private investors with access to funds. The banks much more willing to lend as well on these sort of assets more than they have in the past. So you can see that kind of nearly perfect storm of to see those kind of yields come back.
Can't see it slowing down as well because there's still not much for sale and feels like there's more and more buyers. It's really fascinating to be a part of.
It is. We haven't got much time left, but I do want to just touch on a couple of things that you guys also do some stuff in the childcare and medical space.
Yep.
How are those kind of markets tracking?
Hot.
Hot. Childcare. Childcare's probably fared the greatest, I'd say, out of all the asset classes, maybe albeit fast food. But childcare, since the cash rate rises went up, even when things were going crazy back in 2021 and people were trying to get their money out of the bank, the yields kind of slowed down around the 5% mark and just slowly started to creep into the 4s, but it really just hovered around the 5% mark. But even with the cash rate increases that came up, they really didn't get back up there. Like a lot of the other asset classes softened quite a bit.
Yes.
Maybe 150 basis points in some instances, whereas childcare, it really went up to maybe 5.5%. And obviously there's some that went a little bit higher than that as well, but it really just hovered around that and never waned too much. And now we're starting to see it come back once again down to the low 5s, and it'll probably be not long before it's at 5% again. So
I think Queensland in particular, you've done well in terms of childcare. You've had this huge amount of interstate migration and need for spaces. Like it's probably quite difficult still to find a childcare space in kind of the southeast Queensland.
Yeah, we hear that a fair bit.
But if you look at like a Sydney and a Melbourne, for example, that did build a lot, and they've got a lot of overseas migration. It's very location sensitive, so there's some better results for some locations and pockets, and there has been areas where there has been overbuilt childcare, but certainly that has not been the case when we're looking at southeast Queensland. It's quite a remarkable result what you're talking about in terms of the yields. And medical is much the same, again, off the back of that kind of huge growth, not only for the overseas migration, but that interstate movement of Sydney and Melbourne siders coming to Brisbane or southeast Queensland, spurring on that part of the market.
For sure. I think I'd say on the childcare side of things, the attraction for that is obviously the government underpinning a lot of the income, the subsidies,
and even the training and stuff like that to try to boost up
Absolutely.
Quality workforce and things.
And I think even people obviously speculate, and we've got a federal election coming up very soon, but people are not too concerned on who gets in because they know that whoever gets in is going to want mums and dads back at work to pay more tax. So, it's people feel pretty comfortable that subsidy should stay there. And then on the medical front, that's not that's a pretty easy flow on from the retail centres that we sell, because they're multi-tenanted, and there's a few tenants that interchange there too. They might have a cafe bolted on or other healthcare providers. But the good thing about medical is obviously that the tenants tend to be very sticky, and they all refer each other work, so they tend to never go anywhere.
Especially GPs and dentists are held in the highest regard.
Yeah, so certainly people that are looking at shopping centres with us are more than happy to look at medical practices as well.
And a lot of those yields have been hovering around the 6%, give or take, 50 basis points in medical. But just hasn't been much built, hasn't been much for sale
for
the past few years. So.
Yeah.
Well, you know yourself when you want to go to see a GP, how difficult it is to find one these days.
Oh, and they're always booked out. It's,
Yeah, it's an interesting part of the market, but we've actually gone over time, but I think we're happy to talk all retail, because I feel really confident in retail asset class for this year. It's I said, it's my pick, and if you guys have read any of the stuff that I've written in recent times, it's certainly been about retail, and the fast food and large format retail are particularly interesting. But I think nothing can come back to that really convenience-based retail supermarket with a few specialties. I think that's what people like to visit. It's local. It's easy to get in, easy to get out.
Definitely.
Got loyalty to their stores.
Yeah.
It's a really interesting one. So I think that's it. That's all we've got time for. And I super appreciate you guys tuning in. Love talking about retail, and great to have the boys here. So thank you to Michael, and also to Lachlan, who are from RWC Retail here based in Brisbane. But thank you very much, and we'll see you next time for our next Between the Line Live, which will be coming out shortly. I'm actually going to be in Canberra talking about what's going on in the nation's capital, what's happening with the investment market. They've actually had a really busy start to the year, so we'll talk through a bit of that. But thanks for joining us, and we will see you next time. Thanks, boys.
Thanks so much.
Thank you.